Where does an investor put their money to earn a return? Where does someone place their capital to see it grow? Let's talk about that. One of the places that investors tend to put their money is into financial instruments, a savings account, a certificate of deposit. If they're more sophisticated, maybe a repurchase agreement. But in essence, all those financial vehicles are opportunities to take money, capital, savings, whatever you want to call it, put it to work in a way that the financial institution is going to pay interest on a monthly or a quarterly or an annual basis. There's a periodic flow of cash coming in, which is our return on that financial investment. Now, when that interest is paid monthly, let's say, or quarterly, you, as the principal, have an option of either taking that money and spending it or putting it back into the investment, rolling it back into your investment to help your investment portfolio, your pool of money, grow. Whether you take the money and use it for something else or roll it back into the investment, either way, you're going to be taxed each year on that type of income. We call that operating income because it comes in periodic points, monthly, quarterly, or annually. It comes to you and you have the opportunity to either reinvest it or take it and spend it. It's taxed every year and it's taxed as ordinary income. To the extent that Uncle Sam reaches his hand in and is taking part of that money away in taxes, it causes your pool of assets to grow more slowly. Well, what other type of assets, what other type of opportunities are there for investment? I know some folks that have chosen to place their capital, their investment money, into collectibles, things like fine art. Some people collect cars or coins. I have a friend that is very knowledgeable about art and finds real bargains that he buys, owns, holds for a period of time. And when he sells, it's gone up in value. Over time, collectibles tend to increase in value. And the interesting thing about that is we talked about operating income type of cash flow where you receive it every month and it's taxed immediately and it's taxed as ordinary income. When you own things that appreciate in value, you're not taxed intermittently. There's no tax applied until the day comes that you sell that asset, you monetize that investment, and then for a lot of categories of collectibles, they receive favorable tax treatment. So we see appreciation in value as a type of return. Doesn't have that periodic cash flow, but it's not taxed incrementally, intermittently as well, and it's taxed sometimes at a more favorable rate. Another type of investment somebody might use is to be a day trader, to manipulate, try, buy, sell, swap commodities, stocks. Takes specialized knowledge. It can be very rewarding, but again, it's a short-term trade. The money that comes to the investor as a reward is not really interest like in a financial investment, but it is short-term because it's the profit made on buying and selling and trading things. It gets taxed just like that operating income in each year. So again, Uncle Sam's reaching in and diluting the pool of investment capital to the extent that it's taxed. Also with commodities, it's very risky and it takes specialized knowledge. We could talk for a long time about different types of investment vehicles, different classes of assets that you might choose to invest in. But I want to spend our time today talking about my favorite, which is real estate. When you choose to invest in real estate, you make a purchase of a property, let's say a single family home. Once you've bought that home, you're going to establish, for the most part, what your operating costs are going to be across the time that you own this investment. The black line that you're looking at on the slide is slightly tilted up because there are some components that increase. Taxes go up a little tiny bit. Insurance goes up a little tiny bit. Over time, you spend a little more on repairs and things like that. But the biggest part of our ownership cost is the mortgage, and that's fixed from day one. Now, that's our outflow. That's what's going to be our expense line, but we're also going to have a revenue line. And if we're seeing these black lines as moving across time, you'll notice that the upper line is going upward at a faster rate, and that's because rents tend to increase faster than operating costs. And there's a spread between the two. So when you own real estate, one of the returns that you earn is that periodic operating income that comes to you just like interest comes to an investor who places their money in a financial instrument. Every month there's rental income, there's operating expenses, and at the end of the period there's some small cash flow. I say small because most people tend to highly leverage their real estate investments, meaning they mortgage it pretty highly to minimize the amount of money they put in. And when you borrow 80% of the purchase price, let's say, the cash flow on this periodic income is not going to be huge. But it occurs every month, it's periodic, and we'll talk about the taxation in a second. With real estate, there's also the appreciation and value factor, like we talked about with collectibles. If I bought a home, for example, at $200,000 and I held it for, let's say, 15 years, maybe it goes up in value by 50%. My value of this asset over this period of time is increased by $100,000. That's the return from appreciation and value. The value of my asset has gone up by $100,000, therefore my net worth has grown by $100,000. And I'd ask you this question. Once you own this property, once you've bought it and own it, how much money do you as the owner take out of your pocket to make that $100,000 gain in your net worth occur? You're right, nothing. You don't take any money out of your pocket. You just have to be in the game. When you own real estate and values go up, that increase in your net worth happens without any additional infusion of capital. So we're seeing that real estate has more than one dimension to the return. There's the periodic cash flow on a monthly basis of the operating income, and there's a return from appreciation and value. But that's not the end of the story, because with real estate, in addition to the return from operations and the return from appreciation and value, there's also a return from debt reduction. If we did buy this $200,000 home and borrowed 80% of the purchase price, we'd start out with a $160,000 mortgage. And if we're looking at a time period of, say, 15 years, this is not a get-rich-quick scheme. This is an investment that you hold for growth. You can see that over this same period of time, the mortgage is reduced by about $50,000. Well, if you think back to what we talked about on increasing your net worth, you can increase your net worth when your assets go up in value, but you also increase your net worth by reducing your liabilities. Here, the reduction in debt is about $50,000. That increases your net worth by $50,000. And I ask the same question. Once you own the property, how much money do you as the owner take out of your pocket to make that additional $50,000 in net worth occur? And like before, the answer is zero. Well, where does the money come from to reduce that liability, to pay down that debt? It comes from the rent, other people's money. The very best way to pay off debt with other people's money. So, if we think about taxation, just a quick review, our operating income on a monthly basis is taxed as ordinary income. The appreciation in value is long-term capital gains. Real estate is a capital asset. If you hold it for more than 1 year, it's taxed at a more favorable tax rate than ordinary income. And the growth in our net worth that comes from paying down the debt is not a taxable event at all. Paying down debt is just not a taxable event. So real estate has a three-dimensional return, different than any of the other classes of assets that we've talked about. When investors put money to work, they want to earn a rate of return. They want to earn a return on the money that they've invested. A lot of folks say, what's my return on investment? What's my ROI? Actually, if we're going to be good students of financial jargon, the real term is ROE that they're talking about, return on equity. ROE is simply a comparison of your return, the R, over E, equity, which is what you have in the investment. If I put $40,000 into an investment and I earn $10,000 on it, I want to know what's my rate of return on equity. Sometimes people mistakenly call it ROI, but to be precise, it's return on equity. What's the benefit that we've received, the gain or the benefit, as compared to what we have in it of our own money? And that's what we call return on equity. If you'd like to learn more about investing in real estate, I invite you to give us a call, stop by our office, or check us out on the web at www.blockrealty.com.